Welcome to This Explainer. Today, we're diving into a genuinely fascinating divergence between two absolute retail giants. The recent earnings cycle just delivered a huge, surprising message about the American consumer. And honestly, it reveals a hidden truth about exactly how and where people are choosing to spend their hard-earned money right now. So let's get right into it.
Okay, let's dive into this. Section 1. A tale of two retailers.
On one side, we had Walmart, a literal titan of retail, right? But right after their latest results came out, their stock plunged roughly 9.2%. Ouch. Now, playing on that exact same economic field, we had ROST stores, and their shares did the exact opposite, jumping roughly 8 to 9% in pre-market trading right after reporting their results and raising their outlook. The juxtaposition here is just stark. You have to ask yourself, what exactly did ROST see that Walmart completely missed? To really understand this divergence, we have to look at Walmart's central issue. Despite pulling in a massive $187.46 billion in revenue, which is just a staggering number, Walmart's U.S. comparable sales only grew 2.6%. That actually completely missed analyst expectations, which were sitting around 3.8%, and it represented their absolute weakest U.S. comparable sales growth in 6 whole years. So that right there sets the stakes for why investors were so incredibly spooked.
Section 2. The spectacular quarter. Now look at this number, 10%. That is how much ROST Store's comparable store sales increased in its second quarter. To put that in perspective, it was only 2% in the same period a year earlier. And the absolutely crucial point to remember here is that this increase was driven primarily by actual customer traffic. They weren't just hiking up prices on the exact same group of shoppers to pad the stats. More actual people were physically walking through their doors. And all that foot traffic translated into sheer volume. Total second quarter sales hit approximately $6.3 billion, which is up from $5.5 billion just a year earlier. That is a massive 13% jump in total sales for the 13-week quarter ended August 1st, 2024. Which brings us to the profit explosion. ROST reported $851 million in net income. That's up from $508 million the year prior. We are talking about a blistering 67.5% increase. Earnings per share, or EPS, just jumped from $1.56 to $2.66. On the surface, these numbers are absolutely extraordinary, and they perfectly explain that massive stock surge. But, you guessed it, there's a catch. Section 3. The tariff caveat. Okay, here is the plot twist. $253 million. It turns out ROST received approximately $253 million in refunds from a very specific government trade policy known as IEPA tariffs. This one-time event artificially boosted their EPS by about 60 cents per share. So if you were just reading the headlines and thinking ROST generated all of this massive profit growth purely from selling clothes and home goods, well, that isn't quite the whole story. Now, what's really interesting about this breakdown is when you separate the noise from the signal. Operating margin for the quarter increased by a super impressive 610 basis points, or 6.1% to roughly $1.1 billion in operating profit. But look at how that breaks down. 405 basis points of that came directly from those tariff refunds we just talked about. However, and this is key, even if you exclude that one-time benefit, the underlying operating margin still increased by 205 basis points. So yes, for sure, there was a massive one-time boost, but there was also genuine, undeniable structural improvement in the underlying business.
Section 4. The underlying strength. If we zoom out a bit and look at the first 6 months of fiscal 2024, the momentum is just undeniable. Sales increased 17% to roughly $12.3 billion. Comparable store sales increased 13%. Net income hit approximately $1.5 billion, and EPS surged about 55%, from $3.03 to $4.69. Sure, the tariff refund is definitely baked into those figures, but the broader trend proves ROST entered the second half of 2024 completely firing on all cylinders. And all this momentum gave management the confidence to deliver an absolute guidance shock to the market. They completely blew past their old expectations. Their previous full-year EPS outlook of $7.50 to $7.74 upgraded to $8.61 to $8.77. The midpoint of that guidance jumped by about 14%. This is exactly why Wall Street had to completely rewrite the script on the company's trajectory, and it's exactly why the stock had such a powerful upward move.
And the crazy part is, they aren't just squeezing more money out of their existing stores. They're aggressively expanding their physical footprint. They've actually upped their target to open 115 new stores in 2024. That's 90 ROST Dress for Less locations and 25 dd's discounts. They actually already got 47 of those open during Q2. Combine all of that with their plan to repurchase $1.275 billion in stock, and you've got an incredible capital return story that's built on real earnings growth, store expansion, and share buybacks.
Section 5. Bull versus bear case. So the bull case here is incredibly straightforward. You've got 17% first-half sales growth, a massive capital return program, and management explicitly stating that they are positioned to capture even more market share. But we have to look at the bear case too, because it's equally important. That $253 million tariff benefit, that isn't recurring. Gone. Poof. Furthermore, the back half of the year faces much tougher year-over-year comparisons. Management themselves are actually warning that comparable sales growth is going to moderate, expecting 6 to 7% in Q3 and 4 to 5% in Q4. So it's definitely a moderation from that spectacular 10% we saw in Q2, but honestly, it's still really strong.
Section 6. The value-conscious consumer. And this brilliantly illustrates exactly what's happening out there in the broader economy. Traditional department stores are really struggling right now, but Ross has managed to carve out a very specific, very profitable lane. Their strategy is essentially, don't compete for the consumer who wants everything. Compete for the consumer who wants a bargain. When inflation bites, when household budgets tighten up, and economic uncertainty starts to rise, consumers absolutely still want to buy things. They just become highly, highly selective and incredibly price-conscious.
And we know this isn't just a temporary inflation tailwind either. Ross is succeeding through genuine, sustainable traffic drivers. According to their CEO, they're experiencing both brand new customer growth and higher engagement from their existing customer base. They are actively benefiting from folks shifting away from those traditional, pricier department stores in search of discounted apparel and accessories. It's a fundamental shift in behavior. So here is the final thought I really want to leave you with today. Ross stores just delivered an undeniable blockbuster quarter, sending their stocks soaring while a Goliath like Walmart stumbled. But the most critical question going forward isn't just about how high the stock can go today. It's this. Can Ross keep winning after that temporary $253 million tariff benefit disappears? If they can manage to maintain their margins and their foot traffic without that massive crutch, it might just prove that America's value-conscious consumer is now the absolute strongest force in all of retail. It's a truly fascinating shift and definitely one we'll be keeping a very close eye on.